It comes down to that definition. If an infrastructure meets that definition of ours, if it provides the characteristics that we are looking for in infrastructure, it will make it into our core investable universe. If it doesn't provide those characteristics, it doesn't even make it into the investable universe. So we don't avoid parts of that core investable universe, but what we do is we actively position based on where we feel we are in the economic cycle, whether we are overweight those macro-sensitive stocks such as the user pays, or overweight the regulated utilities or those very defensive, earnings immune stocks when they're needed. So we don't avoid stocks, but we will be overweight one or other of those subsectors as we believe the market dictates. Great question. What is risk? So there's definitely risk. There's risk to every asset. There's greenfield risk if you're building out an asset. There's regulatory risk depending on the regulatory environment. There's political risk, there's sovereign risk. These are all risks that we assess both at a country level before we even make an entrance or look at stocks within a country. So we assess countries based on financial risk, economic risk, political risk, and ESG or sustainability risk. So that risk is all assessed at a country level before we even start looking at stocks. Once we get to the stocks, we're actually looking at a real combination of quality and value. The risks are factored into that value, they're factored into that quality. We look at things like the industry structure, the competitive nature, the regulatory environment, the balance sheets, management performance, their own performance on sustainability or responsible investment strategies. So risks, there's risk in every investment. I guess the big risk to listed infrastructure, it is an equity. It will move with equity markets. That is a risk, but also it's a huge opportunity, as we've sort of just discussed. When the markets overreact or are inefficient, if you really have a view on fundamental value, you can use that opportunity to add alpha over the longer term. ESG is that continuously evolving topic. It's the one topic that's moving very, very rapidly in all forms of investing. Now, ESG has always been part of our process. It's a part of our screening process into getting stocks into the core investable universe. It's part of our country review process. It's part of our company quality assessment, and it's also part of that portfolio construction. So for us, ESG is incredibly important. We probably prefer sustainability or responsible investing, but ESG is part of that. What I would say though is that 4D, we believe the E, the S and the G are equally important. Environmental gets a great deal of focus and it is important, but you can't be environmentally cognizant without being socially responsible and having proper corporate governance. That doesn't make you sustainable. So for us, a great example is you could be a pure play renewable company that's building out without thinking of social aspects or not thinking of shareholder returns. That's not sustainable. By contrast, you could be the best run coal-fired generation plant in the world, but you're also not sustainable. So we're really looking for that strong combination of E, the S and G to see a really sustainable company or country, and that's where we're sort of really focusing our efforts.